And welcome to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis and Judd Carlson. They're the co-founders of Asset Preservation Tax and Retirement Services. Stewart, how are you today?
I'm doing unbelievably well. How are you doing?
I am fantastic. Thank you for asking. And Judd, how are you?
I'm doing great as well. It's a perfect time of year. There's football on TV. I mean, I couldn't be happier.
I know. The weather's been beautiful, and I know that you've both been so incredibly busy. Obviously, people are coming in, they're talking with you, they're planning their financial futures, if you will. Stewart, has it been incredibly busy in the office?
Oh, it has. I mean, right after we're done filming here today, I'm going to be heading over into the office to visit with clients. I mean, you know, this is great. We have the Tempe office here that makes it very convenient to film in.
Most definitely, most definitely. Well, today I'm so excited. We're going to discuss the state of the market, annuities, and fees. So I have to ask you both, the kind of market that we're in right now, Stewart, what do you think? Strong market, good market? Where are we?
Well, I would say it's been a great market, but right now I think, you know, like I've said in the last few shows, we are just seeing tremendous amounts of volatility out there. You know, most likely we're at the end of this bull market. You know, technically it corrected in March of 2020, but, you know, most people see this as a continuation of the same market, you know, since 2009. Listen, the party's going to end soon, or at least I know we're closer to the end of it than we are to the beginning. And you just need to make sure, you know, we have a plan. But we're in this really crazy environment. What I'm going to do is I'm going to go ahead and show you where we are in the S&P 500 right now. We have a slide for you that'll show you we're at this massive peak. And I think, you know, historically, a lot of people have, you know, kind of gone into index funds or these target date funds. Like if you see a target 2035 fund or a 2020 fund, you know, those funds are set up to basically, you know, allocate to what is historically a more conservative investment over time. The problem is that there's no tactical nature to those, you know, those funds. And so a lot of those funds, whether you're in an S&P 500 index fund or a target date fund, they're just going to hold their ratios, their asset allocation balance. And so I think it's really important for people to really understand the risks that they have out there and whether they're really willing to take those kind of risks.
That makes perfect sense. Judd, I have to ask you your opinion as well with things that are going on in the market right now. Obviously, if it does start to correct, what can people do to protect themselves?
Well, you know, we always talk about making sure that you're taking the appropriate amount of risk because people kind of get used to or they see the market going up like it has for the last 13 years and they start to have a very short memory about what can happen. So the first thing we always tell people is make sure you're taking the appropriate amount of risk. The other piece is making sure that if you're nearing retirement, you know, 3 years, 5 years or less, that you know what your plan's going to be. Obviously, you want a chance to sit down with a financial advisor and just know where you are, know how much risk you can take, and then adjust it from there.
All right, Judd, thank you. So, Stewart, if we're going to see a correction, if you will, is there a chance that we could be right on the brink of a recession? Because that sounds kind of scary to me.
Right. So, listen, you know, recession sounds scary, but if you're prepared for it, you'll be just fine. You know, we have a lot of clients in 2008 that really didn't see much loss at all, and they just were properly hedged. You know, it's really, really important to make sure that whatever strategy you take, that you have some downside protection in that plan. You know, the recession is just part of the natural economic cycle. We're going to go through it, and then we're going to see a rebound. Everybody knows you buy low and sell high. Most people don't, though. And I think, you know, the two emotions that guide people when they invest are fear and greed. And you just want to make sure that you're just not too greedy. You know, like in 2008, for example, a lot of people, if you would have, you know, 3-4 months before the market corrected, people were staying in. How nice would it have been to be able to sell a month or two before the drop? Right? Yes, you would have been upset at the time because you didn't get the full gains. You missed a month or two of gains. But look at what followed in 2008, 2009. Hindsight's obviously 2020.
Sure.
And I don't have a crystal ball that actually works. I have one that one of my advisors gave us, but it's the worst gift ever because it doesn't work. But you need to make sure that you have a plan, that you have a strategy in place to do that. And I think what we do at Asset Preservation really well is we offer the opportunity to do a complimentary portfolio review at, there's no cost to you. What we do is we take a look at all your fees, your expenses, what kind of risks you're taking, and also understand if you have any safe assets in there. I think it's really important to make sure you have a portion of your assets that are immune from this market volatility, But to be afraid of the word recession, I don't think is wise, because guess what? There's a plan. You don't want to freeze up. And you want to make sure that, whatever strategy you have, you can actually have access to some of your money. Locking up all your money for the rest of your life doesn't really help either, does it?
That makes sense. So what you're saying is be strong enough to weather any storm. And speaking of storms, Judd, let me ask you, are we looking at kind of the perfect storm right now?
Yeah, I think a lot of people would believe that we are.
Okay.
So we're at a spot where, again, as Stewart mentioned, the markets are at an all-time high, give or take a couple of percentage points. But again, the idea is between the top and the bottom, I know we're closer to the top than we are to the bottom, even though I don't know where exactly either one of those are. So you want to be prepared, make sure that you're not overexposed. The hard part there is the second piece you want to look at is interest rates. So interest rates are at all-time lows, and I believe we do have a slide on this for the 10-year Treasury, just so you can look back at the history over that time. But the 10-year Treasury is at all-time lows, depending on how big of a TV screen you got at home there. You can see back in the early 80s, you're looking at 15, 16% on that. And then it's come all the way down and to where we last year during COVID, it dropped to below 1% for that 10-year Treasury. So you just have to realize that interest rates are low and they're not going to stay that way, especially as the government looks to, take their foot off the gas with their quantitative easing that they're doing, where they're keeping these rates artificially low longer than perhaps they should be. So interest rates start to rise, that's going to affect the value or prices of bonds, and that has always been people's traditional hedge against the stock market falling. So you've got those two pieces in there, and then inflation. Anybody who's looking at used cars or eggs at the grocery store, milk, knows that inflation is out there. We're going to get a massive jump for the cost of living adjustment, COLA, related to Social Security next year. Now, the downside is that most of that gets eaten up in their Medicare premium, so a lot of retirees aren't going to see that already. But for us consumers, that means that our money is not buying as much today as it did a year or 2 or 3 ago. And then the last piece is taxes. We live in an amazing country that has done a fantastic job to help the country keep going, to help us rebound from what COVID took away from us. But the downside of that is the stimulus and the assistance and the help and the infrastructure, all those things, we got to pay for it somewhere. So we've got taxes are going to be going up. We are in one of the most tax efficient environments that has ever existed. And so we talk about the planning piece, have that plan going forward so you can handle all these different facets of the perfect storm, as well as just know what you're going to do today.
Thank you so much, Judd. That makes perfect sense. Stewart, I know that you and Judd have a very special offer that you want to present to the viewers at home today. Let's talk about that and then open the phone lines. Absolutely.
So what we're offering today is a complimentary portfolio review. If you just give us a call at 833-652-7829, what we're offering you today is to take a look at your portfolio to see what kind of expenses you have built in there that are hidden inside, what kind of tax implications are hiding behind the corner as well. Just give us a call at 833-652-7829. We'd be glad to help.
Stewart, thank you so much. Judd, thank you so much. To the viewers at home, the phone number to call is on your screen. That number is 833-652-7829. We have to take a very short commercial break, but don't go anywhere. When we come back, we're going to talk about what you can do to protect yourself from a market correction. Stay tuned.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old, they've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. You know, I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart, Willis, and Judd Carlson. They're the co-founders of Asset Preservation Tax and Retirement Services. Had to think about that for just a second because I was thinking about what I wanted to say, which was coming out of the commercial break, just talking about, so there is something that you can protect yourself against the market correction.
Yeah, I think what's really important, first and foremost, is you need to make sure you're diversified. And when we talk about diversification, Cynthia, we're not just talking about a diversification of investments, we're also talking about a diversification of perspectives. And what I mean by that is oftentimes financial advisors will be picking the funds for you themselves. And the reality is that they see the world only through their eyes, right? Through their perspective. And, I would just ask the question, what if they get it wrong? Right?
Absolutely.
What if they get it wrong? And, the other thing is that no one's going to get it right all the time. Right? We're all human. No human's going to get it right all the time. And you just want to make sure that all your eggs aren't in one basket. And what I want to show you here is the slide that Judd showed you earlier, the 10-year Treasury slide here. And what that 10-year Treasury slide will show you is the interest rate environment. Well, historically, people have run to bonds like Judd was talking about. But as interest rates start to rise, we can start seeing an increase in, bond issues. So by bond issues, I mean problems. So if interest rates rise, bond values drop. Now, we haven't seen that happen, systemically for 35 years. But the normal thing, Cynthia, is basically for people to shift as they get closer to retirement to higher bond portfolios. So if you're working, you may be in an 80% equity, 20% bond portfolio. As you get closer, you move to 30% bonds, 70% equities, and so forth. And going into retirement, you may have a 40% equity, 60% bond. Now, what about that 60% that's in bonds that you want it there because it's safe, and historically it's worked. But if we see this, quick rise in interest rates, we could see that dramatic, downside problem. And, for those people that do not want to, lose money, that are completely uncomfortable with market volatility. I mean, we have clients all the time that come in and they can't sleep at night if the market moves, right? And for them, there's some fixed options that are available too. And some of those, can be CDs, they can be annuities. The problem with CDs right now is they just don't pay any interest, right? We're in the lowest interest rate environment in history. You're going to buy a 0.5% or maybe 1% CD. So a lot of people are moving towards annuities. And I think it's really, really important for people to know what they're buying, because they'll attend these dinner seminars and see these crazy illustrations of what an annuity will do. but they don't really understand it, right?
Yeah.
They had this great sales pitch, but they were never, really understanding. They just saw this, kind of neat pitch, and they bought into them. And you just want to make sure you're buying the right thing.
Okay, that makes perfect sense. Well, let's talk a little bit about that. Annuities. Judd, let's talk about the different types of annuities.
Yeah, absolutely. And I think that's probably the biggest piece of educating folks, because making sure that you know what you're getting, good, bad, indifferent. I think it was Susie Orman at one time before 2008 would give a lot of flack to the term annuity. And then after the big correction and losses in 2008, 2009, she came out and said, well, some annuities can be okay. I think the thing to learn from that is making sure that, no one should have 100% of their nest egg in any one product is probably the best way to put that. But the first type of annuity that I think she was talking about and that a lot of people are familiar with is a variable annuity. Now, a variable annuity, it means that it's an annuity, so it's an investment backed by an insurance company. But by variable, the money that's in there can go up and down just like the stock market.
Okay.
There are some, protections and provisions here and there, but where we like with our clients, if we're going to take market risk, we would rather be in the market, be very efficient, have low fees, and then take that risk on. Inside the variable annuity, there are typically similar investments you could get without that you're paying a much higher fee. So again, you still have market risk and you're paying additional fees, so you want to be aware. Then there's what's called a fixed annuity, which is very similar to a CD. You buy it for 3 years or 5 years or whatever the term is, and they give you a flat fixed rate across that time period. Again, it's backed by an insurance company, so a fixed annuity is also going to defer the gains on that money until you end up taking it out. The next one would be an immediate annuity, which I think is what a lot of people are more familiar with. They think about when you win the lottery, you have a choice of getting half of the money up front, or you can get this annuity payment for the next 20 years. So an immediate annuity is an annuity that the money goes in and then payments start coming back out of it to the client. And they can almost create their own little pension that way. But once you put the money in there, that lump sum of cash is gone, and now you own that income stream that's either going to be for the rest of your life or for a certain number of years, plus the ability to pass it to your beneficiaries. And then the last annuity that we talk about is a indexed annuity, or what are sometimes called fixed indexed annuities. And the idea there is, again, annuity, so it's backed by an insurance company. It's fixed, so you can't lose anything in it. Your principal can't go down based on market performance, unlike the variable annuity. And then what you make inside that policy is going to be determined by external indexes. S&P 500, NASDAQ, Bloomberg US Dynamic Balance Index. But the idea is if the markets go up, you're never going to make the kind of money you could make in the market because you're not taking the risk. But if the markets go down in that fixed indexed annuity, you don't lose any premium. So the worst case scenario, you would get a zero that year, or the term they say, zero's your hero.
Sure.
But the idea behind this is you need to be educated if you're purchasing an annuity, because they're not for everybody, but you want to know how much access you have to it, what the provisions are, and you want to make sure that you're not getting dinged for additional fees that pay for stuff that you may never use or don't ever need.
That makes perfect sense. Judd, thank you for that excellent explanation of the different types. Stewart, your thoughts on annuities?
Well, an annuity is just a product. I don't like them or dislike them. I think if they fit a purpose for a client, they make sense. If they don't, they don't. And I think that oftentimes a lot of insurance agents and kind of pseudo advisors out there are finding a solution for, an annuity is always the answer for everybody, and it isn't. I actually sit on a committee for one of the largest insurance companies in the world on their design committee and help design these products. And oftentimes my voice is unwelcome because a lot of people in the industry want all of these lifetime income guarantees and all these bells and whistles. And I usually say that, the people that need all of those goofy things are basically, poor salesmen. They're people that are relying on gadgets and distractions. And I think they're really expensive. And, if you have an annuity that has been there for, 7, 8, 10 years and hasn't done what you thought it was going to do, and you're concerned about its performance because it wasn't what was promised or delivered, just give us a call. Give us a call at 833-652-7829. We'll take a look at what kind of fees you're paying inside that annuity. Are there any modifications you can do? Because sometimes we can't move the product out of there because it's there for 10 or 12 years or 15 years for some of these, bad products. But, there's things you can do to modify them, to make them better internally. Just give us a call at 833-652-7829. We'd be glad to give you a second opinion on your annuities as well, to let you know if they're good or bad.
Stewart, thank you so much. Judd, thank you so much. To the viewers at home, the phone number to call is on your screen, and that number is 833-652-7829. We have to take a very short commercial break, but don't go anywhere. When we come back, we're going to talk a little bit more about fees. So you'll want to hear what these gentlemen have to say. Stay tuned.
This is the story of how you get from here to there. Right now you're here, but in the future, you want to be there. And from here, there looks pretty good. But so few get to there. Why? Well, of those who do make it, some will have luck, but most will have a strategy. They will save and invest, grow and protect, and they will work with advisors who will help guide their way. If you're looking to get somewhere, to get there, we know how to set a course. It's what we do, and we do it well. We're investment specialists, retirement advisors, insurance experts, and financial planners. We have innovative wealth tracking tools to monitor your progress every step of the way. Wherever you are now, we can help you get to where you want to be. The road between here to there is shorter for those who know the way.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis and Judd Carlson. They're the co-founders of Asset Preservation Tax and Retirement Services. Gentlemen, a great show we're having, obviously talking about such important topics. But one thing I want to cover in this segment, we tapped on fees, but let's dive into that a little bit further. Stewart, what types of fees should people be looking for when it's coming to advising?
Well, when it comes to financial products and financial advice, you want to make sure that you understand everything about your portfolio. Now, first of all, we are fiduciaries, first and foremost. So we basically make a percentage of the assets we manage that are in securities so that if you do better, we do better. It's not a right fit for everybody, but you want to make sure whether it's a right fit for you. Right? But a lot of people just have no understanding of the kind of fees they're actually paying. We had a client, for example, I'll ask him, hey, how much are you paying your advisor in fees? And, like 9 out of 10 times the answer is, I don't know. I don't really know. I don't understand it. Well, I think that's a problem. But sometimes people will think they understand their fees and they'll say, oh, I'm paying them, 1%. But what they're not seeing is the load costs of some of these fees, or they're using old style mutual funds. Judd talks about it all the time of the world's changed. Yeah. If you have the same mutual funds that you've had for 20 years, those were designed back when brokers used to make their money off of, transactions, and they were just really, really expensive. There are now ETF products out there that are, 0.2%, not 1.2 or 2% in there. So it's really important to understand what are your internal fees, and then what are you paying for advice? Now, just remember, Judd and I don't work for free, obviously. We've got to pay the bills too. You just need to make sure that it's a fair relationship that you have, that you understand what you're paying, and that you're getting what was promised to you when you paid those fees. And honestly, Cynthia, a lot of advisors do the least amount of work necessary to get paid, right? I look on my Facebook page and, my wife is like, hey, why is this guy on vacation? And you never take any vacations. And it's because we put a lot more work into our clients than most people do. They'll have their quick little half-hour meeting a few times a year. There's no tax planning or estate planning or any of that kind of stuff. And I just think it's important that, you demand more from your advisor.
Absolutely. Judd, are fees always a bad thing? Let's talk a little bit about that.
No, I don't think they are. I mean, again, what tends to happen for most folks is they get upset when there are fees that they weren't told about, or if they're paying for fees that are not covering anything. Going back to kind of some of those annuities that we chatted about earlier, some people come in and they need a big death benefit. If something happens to one of them and their pension goes away or the Social Security part of that goes away, they need a enhanced death benefit. So if they're paying a fee on an investment to cover that, well, they need that. That makes sense. But if somebody comes in and they've got plenty of retirement income and they want some safety in their portfolio and they don't need external income, they don't want to be paying a fee on one of their investments to help guarantee the income that they're never going to use. Yeah. And again, even worse, they're going to be in a spot where they weren't told about that fee. So you want to make sure that you're getting what you pay for. And we're certainly not the cheapest out there, but we're also not the most expensive. Yeah. Every now and then we'll get some clients that come in and they've read a book or listened to somebody on the radio and they want to do, I want to sit down with you for 5 or 6 hours and I want to pay you for your time and I want you to put together a plan. And we're certainly able to do that. The problem is if we put together that plan and then something like COVID happens or a few years back, Brexit happens, that puts us in a spot where I need you to come back in and let's make some changes to that plan. Well, now it's like, wait a minute, now you're going to turn the meter back on and you're going to bill me again. So what we always try and share with clients as a fiduciary, the way we handle things, if we're sitting down and managing a portion of your portfolio for you, you are paying us a fee to manage that. But along with that, you're getting the tax advice. You're getting the holistic planning, the big picture, when to take Social Security, how to pull some money out of the investments, Roth conversions. You're getting all of those pieces and they're included in that fee that, yes, you're paying us to manage that account. So it's all about expectations and making sure that you're getting something for the fee you're paying. Sure. Again, being the cheapest isn't always the best, but paying the most doesn't necessarily guarantee you're going to get the best service either.
That makes perfect sense. And Judd, I know that you and Stewart have a very special offer to present to the viewers at home. We have about a minute left in the show. Do you want to talk about that?
Absolutely. For anybody out there watching that wants to come in, get that second opinion, give us a call at 833-652-7829. Set up a time to come to one of our 3 office locations. We're in the West Valley there in the Peoria, Sun City area. We've got our Scottsdale office and then the Tempe office where we're filming today. So 833-652-7829. Come on in, bring in everything that you've got that you want us to cover for you. Taxes, portfolio, fees, risk, you name it. We'll put it together for you, and there's no cost or obligation.
Gentlemen, thank you so much for another amazing show this week. To the viewers at home, most specifically, thank you for spending time with us. That number to call is 833-652-7829. Any questions you may have about retirement, Stewart and Judd have the answers for you. Be safe, be happy, be blessed. We'll see you back here 1 week from today. Thanks for watching.